Yes, hello everyone. Welcome to our second lesson of financial management. Still, we are talking of topic number 1. And today, I would want us to look at measuring managerial performance, compensation, and incentives. Measuring managerial performance, compensation, and incentives. So the most important thing, ladies and gentlemen, you're supposed to know is the fact that all this is boiling down from the agency theory that us as shareholders, we've been able to appoint managers who are going to run that particular company on our behalf. So if we don't align their interests with ours, at the end of the day, we do not have a company. At the end of the day, we shall not be having a company. So when we talk of managerial performance, how do you want this thing to be? How do you want them to perform? Of course, ladies and gentlemen, as shareholders, we want to maximize our wealth. It is wealth maximization that we are pursuing. And we would want those managers, when they are working for us there, when they are working there on our behalf, to ensure that that particular objective at the end of the day is met. So we are told here that a manager's performance, if you can see here, a manager's performance is measured by looking at 2 criteria: effectiveness and efficiency. Effectiveness and efficiency. So we have to ensure that our managers are effective in how they are operating, and of course, what here, efficient. So effectiveness is achieved when the organization pursues the appropriate goal or goals. We can only say that these people are effectively discharging their mandate if they are working towards the overall goal of the firm, which is wealth maximization. Wealth maximization. Well, ladies and gentlemen, when we talk of efficiency, the most important thing that you're supposed to know under efficiency is the fact that efficiency, we are looking at input versus output. So whatever we put into the system, we need to take advantage. We need to take advantage of the situation by ensuring that the output will be greater than the input. So you're told where efficiency is achieved by using the fewest inputs to generate a given output. In other words, minimizing cost of resources needed to achieve the goals. Effectiveness can be seen as doing the right things, while efficiency can be said as doing the right thing, as doing things right. The most important, ladies and gentlemen, thing we are supposed to know is that under efficiency, we can only be said to be efficient if we are able to derive maximum satisfaction from the little that we put in, So our output has to be greater. Now, if these managers are able to pursue those 2 idyllic criteria, effectiveness and efficiency, then we need, ladies and gentlemen, to compensate them, to incentivize whatever they are doing. So, and as such, will be required to come up with an appropriate bonus strategy. If, for example, they were to post huge profits, it will be greedy of us to go ahead and share those profits amongst us investors, leaving them out. We need to set aside some percentage for them as bonus. And we are told, ladies and gentlemen, here that executive incentive schemes should be competitive to attract and retain high-quality managers. This can be done by communicating and reinforcing key priorities in firms by linking bonuses as key performance measures. And then number 2, encourage performance evaluation, which is very good, by rewarding good performance of managers. We have here forms of bonuses. They vary from, of course, one organization to the other, and payments to these great people who are driving our agenda could be in form of cash or shares of the company, could be in terms of giving them stock options, could be in terms of giving them performance shares, shares related to performance. And then we have a stock appreciation, what here? Rights. Stock appreciation rights. So we are told here that bonuses can also be made, which are contingent to corporate results. So that, ladies and gentlemen, if these people are able to post great profits, contingent on that, contingent, depending on the profit that they raise, we should be able to give them a profit that is pegged on, or rather a bonus which is pegged on the profit. So be based on annual performance or performance over a number of years. The most important thing that you're supposed to know, ladies and gentlemen, we would want to drive performance of our entity forward. And of course, as fast as possible. And for us to do that, we have to incentivize these managers. We must give them some great bonus schemes, which you have said up there, have to be communicated. The bottom line being that if the firm succeeds, if the firm excels, the managers who are working with us will also move up with us as shareholders. So they've gone ahead, ladies and gentlemen, here to explain those bonuses, schemes. Like now when we talk of cash stock shares, we are told company profits and individual performance forms the major bases used to determine the amounts of bonuses. These are current bonuses which are paid in cash, monetary consideration or shares, i.e. ownership consideration. They reward executives on short-term performance. Therefore, there is a risk of what we call short-termism, where these managers will be thinking of the current year's profit. They can do anything. They can make sacrifices, sacrificing greater things for the organization on the motive, with a motive of just maximizing our short-term profits, their short-term profits. Ladies and gentlemen, this short-termism is also a dangerous thing. As you're saying that we would want to incentivize these people by giving them bonuses which are pegged on profits, chances are they may even decide to manipulate those profits here so that they window dress the profits to ensure that their bonuses will be high. They will sacrifice things like training costs. They will not train workers because they know in the short term, the training will not be that important to them. But of course, in the long term, ladies and gentlemen, training employees who are well trained will become more productive, We are saying cash share schemes based on profitability are great, but we as directors have to remember this particular important issue of short-termism. Ladies and gentlemen, of course, I know the advantages, disadvantages are here. You can pause a little bit and read them. Stock options. A stock option gives managers the right, but of course not an obligation. It's an option, it's an alternative, to purchase the company shares at a future date and at a price established when the option was granted. With the stock options, it will be assumed that managers will attempt to influence long-term performance rather than short-term performance. So to discourage this short-termism, we'll be offering them what we call stock options. We'll tell them, hey, you guys are managers at Safaricom. If the price of Safaricom shares hits something like 40 bob in a span of say 2 or 3 years from today, then we shall give you the right, but of course not an obligation to you to purchase these shares perhaps at a very low, modest price, which could be like 10 bob, So stock options basically are encouraging long-termism. If we give these managers a 5 years contract, ladies and gentlemen, you can tell them that by the end of the 5 years, if this is how our performance will be, then we shall allow you to be part owners of this particular company by procuring our shares at a very low price. So we have the advantages and disadvantages displayed there. What you need to do is just to pause. You pause the video, and then of course you watch this particular section of this important bonus scheme. And then we have the performance shares, pretty similar to what we've just seen up there. We're just simply reinforcing our point here. These are shares given by the company to managers or employees if they attain a specific level of performance. If they attain a specific level of performance, the main target is to attain a certain level of performance for a number of years. Consistency is important here. Executives receive rewards for maintaining a consistent performance or exceeding that performance. Ladies and gentlemen, that is okay. And then we look at D, where we are talking of stock appreciation right. Stock appreciation right. So basically here, we are trying to develop, ladies and gentlemen, a scheme where we are telling these people that would want to grow our market footprint at the stock exchange. So we want our price, share price, to keep on increasing. And should it appreciate, then we shall give you some bonus based on the appreciation. Based on the appreciation. So we have here the executive stock appreciation rights. These are deferred cash payments based on the increase in the stock price. So I hope that is important. I hope that is helpful, and you shall be able to look at it later on keenly. Ladies and gentlemen, we have this other subtopic which is quite important for topic number 1, what we are calling the ethical issues in financial management. So when we talk of ethics, we are looking at that art of trying to discern between what is right and wrong, what is right and wrong. When it comes to financial management, we've said that our major goal is profit maximization or wealth maximization. Ladies and gentlemen, as you pursue that particular goal diligently, chances are you will be stepping on other stakeholders' toes. Ladies and gentlemen, remember, when we talk of profit maximization, we are only pursuing a profitability, high profit, at whose advantage? At the advantage of the shareholders, So we are only looking at one party. So chances are we shall have to engage at unethical practices as we pursue this greedy assumption. And that is why now we need to look at the balance. That is why I have to take some time to train you on the ethics when it comes to financial management. Yes, as we pursue this quantitative goal of making huge profitability, there are qualitative aspects you're supposed to be looking at, which may not be very important in the short term, but in the long term, they are going to pay you big time because they'll be considered to be ethical by the other stakeholders. So, ladies and gentlemen, as we pursue our greedy objective of profit maximization, let us not mess up with our customers. So quality is something that is ethical, is something that is right, which we have to consistently look at, ladies and gentlemen. So quality products, our customers have to be happy. Ladies and gentlemen, our employees have to be happy as we rise up there in terms of ranks, going up there in terms of our profits. Ladies and gentlemen, let us not step on these employees. If it trickles down to us as managers, it has to go down to these employees. Let these employees feel part and parcel of our organization. Ladies and gentlemen, as much as I'm saying that this profit, of course, is a profit, pursuing profit maximization is a greedy assumption, but also remember, it's the ethical thing to do. For you as a finance manager, ensure that these investors, given that these investors have put in money, given that these investors have put in their money in the company, you also have to strive to give them a return on their investment. That is the right thing to do. It is the right thing to do. Ladies and gentlemen, don't forget also the community in terms of financial management in light of ethics. Don't forget the community. Remember the philanthropic responsibility, what we call the CSR, the company social responsibility. There is no way you can exist as an organization without the society. So the society is giving you business. The society is giving you workers who are coming to provide some important essential services to your company. So you owe them. You owe them for your existence. So it behoves the fact that at the end of the day, you have to get out of your way, even if you may make a little losses here and there, but ensure that you're doing something for the society. Ensure that you're doing something for the society. You're doing something for the society. Don't also forget the legal responsibility. Legal responsibility, for example, pay your taxes. Don't try to cheat the taxman. The taxman at the end of the day will catch up with you. The taxman at the end of the day will catch up with you. So ladies and gentlemen, this is quite important for you to remember ethics. Remember the threats to ethics that you did in your auditing. As you do your financial management, remember those threats of surface. We normally talk of surface. Surface downwards. S stands for self-interest. We have advocacy. We have familiarity. We have intimidation. We have what we call self-review. Try as much as possible as a finance manager, even if you're an employee, try to give what we call independent advices. Even if you have an interest in some action, in some activity, try to disclose that, fine, I have this interest. But the truth is, this is what we need to pursue. This is what we need to pursue. Don't champion your interest throughout using the advocacy. Don't be an advocate of your interest only. No, that will kill the company. In terms of ethics, that is so much wrong. That is so much wrong. And of course, should you feel that you really are under undue pressure, you are intimidated, at times as you're doing this work, you could touch on a few toes, which could be very dangerous for you. So under intimidation, if you feel really that you are highly intimidated, you need to do the honorable thing, which of course is to do what here? To resign, which is to resign. So that is very, very important. And of course, as you move on, as you grow, it will be very important for you to be having like ethics education with everyone in the firm. Let us embed this ethics of culture in the organization, in the institution. So educational, or rather ethics, educating employees on the ethics ethos of the company is very, very important. Even ensuring that at the end of the day, you'll be having a department, like a manager who is in charge of ethics. That is very, very important. So that marks the end of this particular session. I hope it has been helpful. Please keep engaged. Keep engaged with us. At the end of the day, we shall overcome. Thank you, and thank you very much.